Something extraordinary just happened in the silver market that most people completely missed. While everyone was watching the price bounce around, a seismic shift occurred beneath the surface. Silver's open interest just surged to levels we haven't seen in years, and if you understand what this means, you're about to witness one of the most significant moves in precious metals history. Let me paint you a picture of what's actually happening right now. Open interest represents the total number of outstanding contracts in the futures market. When it explodes like this, it's not random. It's not noise. It's the footprint of massive institutional positioning. And right now, that footprint is telling us a story that should have every investor paying attention. Here's what makes this so critical. In the past 3 weeks, silver open interest has jumped by over 40,000 contracts. That represents 200 million ounces of silver. To put that in perspective, that's nearly a quarter of annual global mine production being claimed in the paper market in less than a month. Someone is making an enormous bet, and the smart money always knows something before the rest of us figure it out. Now, I need you to understand something fundamental about how this market actually works, because this is where it gets fascinating. The silver futures market operates on leverage. When you see open interest spike like this, you're watching two things happen simultaneously. First, you're seeing new positions being opened, people placing bets on where silver is headed. But second, and this is crucial, you're seeing the buildup of potential energy in the system. Every one of those contracts represents a claim on physical silver that may or may not exist in the quantities being traded. Think about it like this. Imagine a game of musical chairs, but instead of 10 people and 9 chairs, you've got 100 people and maybe 20 chairs. As long as the music keeps playing, everything seems fine. But the moment someone calls for delivery, the moment those paper contracts need to convert to physical metal, that's when you find out how many chairs actually exist. And right now, with open interest exploding, we're adding more and more players to a game that's already dangerously overcrowded. Let me show you what happened the last time we saw a pattern like this. Go back to early 2011. Silver open interest started climbing in December 2010, building steadily through January and February. Most analysts dismissed it as normal market activity, but a small group of traders recognized what was actually happening. They saw the commercial shorts getting squeezed, they saw the long positions piling up, and they understood that a massive amount of leverage was being loaded into the system. By April 2011, silver had rocketed from $18 to nearly $50 an ounce in just 4 months. The open interest spike was the early warning signal that a historic move was coming. But here's what makes the current situation even more explosive than 2011. Back then, we didn't have the supply constraints we're facing today. We didn't have the industrial demand from solar panels consuming 20% of annual production. We didn't have electric vehicles requiring silver for every charging station and battery system. And we certainly didn't have central banks around the world actively working to undermine the dollar's dominance while accumulating precious metals at record pace. The fundamentals supporting silver right now are unlike anything we've seen in modern history. Global silver mine production peaked in 2016 and has been declining ever since. We're pulling less silver out of the ground every year, while industrial demand keeps climbing. The solar industry alone is projected to consume 85% more silver by 2027 than it does today. Electric vehicles, 5G infrastructure, medical applications, the green energy transition, all of it requires silver, and there's no substitute that works as well at any price point. So when you see open interest exploding in a market that's already facing structural deficits, you need to ask yourself, who's positioning and why? Let me tell you what the data is showing. The Disaggregated Commitments of Traders report, which breaks down exactly who's holding what positions, reveals something stunning. Managed money, the big hedge funds and institutional players, they've been building long positions aggressively. At the same time, the commercial traders, the banks and dealers who typically short silver to hedge their physical operations, they're not adding shorts at the rate you'd expect. That divergence is critical, because it suggests even the commercials aren't confident they can source enough physical silver to cover aggressive short positions. Now here's where this gets really interesting. The COMEX, the exchange where these futures contracts trade, they have warehouses where physical silver is stored. Those warehouse stocks have been declining steadily over the past year. We're down to about 280 million ounces of registered silver, the portion that's actually available for delivery against futures contracts. But remember, open interest represents claims on over 1 billion ounces. The ratio of paper claims to physical metal available for delivery is approaching historic extremes. It's like writing checks when you know your bank account doesn't have enough to cover them all, and you're just hoping nobody tries to cash them at the same time. This is the setup for what traders call a short squeeze, but on a scale that could reshape the entire precious metals market. When open interest is this elevated and physical supply is this tight, all it takes is a catalyst. Maybe it's a major industrial buyer deciding they need to secure supply and demanding delivery. Maybe it's a geopolitical event that sends investors rushing into hard assets. Maybe it's simply the mathematical reality that you can't have 10 claims on every ounce of physical silver forever without something breaking. Let me tell you about what happened in the nickel market in March 2022, because it's a perfect example of what can occur when paper markets disconnect from physical reality. The London Metal Exchange had nickel trading normally. Open interest was elevated, and then a massive short squeeze erupted. Nickel prices went from $29,000 per ton to over $100,000 per ton in less than 48 hours. The exchange had to halt trading and cancel trades because the system couldn't handle the delivery demands. Billions of dollars were at stake, and the entire market structure nearly collapsed. Now, silver is a much bigger market, but the same dynamics apply. When leverage gets extreme and physical supply is constrained, price can move in ways that seem impossible until they happen. Quick aside here, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description. Covers how to get physical gold and silver into your retirement account without tax penalties, which is something worth understanding given what we're seeing in these markets. Worth checking out if that's relevant to your situation. Anyway, back to what this open interest explosion really means for where silver is headed next. Because here's the thing. This isn't happening in isolation. While silver open interest is surging, we're also seeing unprecedented activity in the physical market. Premiums on silver coins and bars have been elevated for months. Delivery times from major mints are stretching out. Retail demand is strong, but more importantly, we're seeing large institutional buyers entering the physical market in size. The silver ETFs, particularly the big ones like SLV and PSLV, they've been seeing inflows. That means real money is moving into silver, not just speculative futures positions. And then there's what's happening in the mining sector. Silver miners are trading at valuations that make no sense if silver stays at current levels. The market is pricing these companies as if silver is going to $20, but their cost structures and the fundamentals of supply and demand suggest we should be looking at much higher prices. Smart investors are noticing this disconnect. When you see open interest surging in futures while mining stocks are undervalued and physical premiums are elevated, you're looking at a market that's coiling up for a major repricing. Let me walk you through the mechanics of what happens next, because this is where understanding market structure becomes crucial. As open interest builds, the shorts, the people betting silver will go down or stay flat. They're taking on increasing risk. Every dollar silver moves higher, they lose money on every contract they're short. At some point, if price starts moving against them significantly, they have to cover. They have to buy back their short positions to limit losses. But when they buy, that pushes price higher, which forces more shorts to cover, which pushes price even higher. It's a feedback loop, and with open interest at these levels, the potential for that loop to spiral out of control is very real. Now, I want you to consider the broader macro environment we're operating in, because that's the backdrop that makes this open interest surge so significant. We're living through the most aggressive monetary experiment in human history. Central banks printed more money in the past 3 years than in the previous decade combined. The M2 money supply in the United States expanded by over 40% since 2020. That's not inflation. That's the cause of inflation. And while the Fed talks about fighting inflation by raising rates, the fundamental reality is that there are trillions more dollars chasing the same amount of goods and services. Silver, like gold, is real money. It's been money for 5,000 years because you can't print it. You can't create it out of thin air. And it has intrinsic value based on its unique properties. When fiat currencies are being debased, when the purchasing power of your dollars is being systematically destroyed, precious metals are where wealth flows for protection. And silver, trading at a gold-to-silver ratio that's still historically wide, offers leverage to that trade. If gold moves 50%, silver historically moves 100% or more. That's why this open interest surge matters. It's not just about silver. It's about a global loss of confidence in paper currencies and a rotation into hard assets. Look at what China is doing. They've been accumulating gold for their central bank reserves every single month for over a year. But they're also the world's largest silver producer, and they're keeping more of their production domestic. Russia, after being cut off from SWIFT and having their dollar reserves frozen, they're backing their currency with gold and commodities. The BRICS nations are working on a commodity-backed trade currency that would bypass the dollar entirely. This isn't conspiracy theory. This is official policy being implemented right now. And when you understand that the dollar's role as global reserve currency is being actively challenged, you understand why smart money is positioning in precious metals. The open interest explosion in silver is a symptom of a much larger shift. It's institutions recognizing that the old rules don't apply anymore. It's hedge funds positioning for currency debasement. It's industrial users trying to secure supply before prices gap higher. It's a market that's been suppressed for decades through paper manipulation, finally reaching a breaking point where physical reality has to reassert itself. Here's what most people don't understand about silver specifically. It's consumed. Unlike gold, which mostly sits in vaults and gets recycled, silver is used in industrial applications where it's not economically recoverable. Every solar panel, every electronic device, every medical application, that silver is gone. It's not coming back into the supply pool. So while gold has thousands of years of accumulated above-ground supply, silver's above-ground inventories are actually declining. We're using more than we're mining, and that deficit is structural, not temporary. The Silver Institute estimates we're running a supply deficit of over 200 million ounces annually. That's being made up by drawing down existing inventories, but those inventories aren't infinite. At some point, and we may be approaching that point now, the market has to reprice to incentivize more production or ration demand. And when you're talking about industrial users who need silver for their production processes, they can't just stop buying because price goes up. They have to pay whatever it costs. That's inelastic demand meeting constrained supply, and it's a recipe for explosive price moves. Now, let me connect this back to the open interest surge, because this is where it all comes together. The futures market is supposed to be a price discovery mechanism. Producers and consumers use it to hedge their exposure, and speculators provide liquidity. But when open interest gets this elevated relative to physical supply, when the paper market is trading multiples of what actually exists in deliverable form, you're not discovering price anymore. You're creating a fiction. And that fiction can persist for a while, but eventually, reality intrudes. Think about 2008. The housing market was built on a fiction that prices could only go up and that mortgage-backed securities were safe. The leverage in the system kept building. Everyone knew it was unsustainable, but the music kept playing so everyone kept dancing. Until suddenly, it didn't. The fiction collapsed, and the real price of risk had to be paid. Silver's open interest surge is showing us a similar dynamic. The fiction is that you can have unlimited paper claims on a finite physical resource. The reality is that at some point, someone's going to demand delivery, and there won't be enough to go around. When that happens, and I'm not saying if, I'm saying when, because the math doesn't work any other way, you're going to see price moves that shock people. We're talking about silver potentially moving 50% or more in a matter of weeks, not because of hype, not because of speculation, but because the market structure demands it. The shorts will have to cover, the physical buyers will have to pay up, and the price will have to rise to a level that either brings new supply online or destroys enough demand to balance the market. And here's the kicker. The level where that happens might be multiples of where we are today. If you look at silver's inflation-adjusted all-time high from 1980, we'd need to be above $140 an ounce just to match that in today's dollars. Now, I'm not predicting we go there tomorrow, but I am saying that the current price of silver, trading in the mid-20s, doesn't reflect the supply-demand fundamentals, doesn't reflect the monetary debasement we're experiencing, and certainly doesn't reflect the risk building in the futures market with this open interest explosion. The smart money sees this. That's why open interest is surging. They're positioning ahead of what they believe is coming. And if history is any guide, when you see this kind of institutional positioning in a market with fundamentals this strong, you want to be paying attention. Because by the time the mainstream media is talking about silver's move, by the time your neighbor is asking you about buying silver, the big gains have already happened. The opportunity is now, while most people are still ignoring what the data is screaming. Let me give you one more piece of the puzzle. The U.S. Mint, which produces silver eagles, the most popular silver coin in America, they've been rationing supply to dealers. They can't produce enough to meet demand. The Royal Canadian Mint, the Perth Mint in Australia, they're all experiencing the same thing. Physical demand is overwhelming production capacity. Meanwhile, the paper market is trading as if there's unlimited supply. That disconnect can't persist. Either the paper price has to rise to reflect physical scarcity, or the paper market loses credibility entirely and people stop trusting it for price discovery. We're at an inflection point. The open interest surge is the canary in the coal mine. It's telling us that major players are taking positions for a significant move. The fundamentals support that move being to the upside. The supply-demand deficit, the monetary debasement, the geopolitical shift away from the dollar, the industrial demand growth, all of it points in the same direction. And when you layer on top of that the technical setup with open interest at these levels, and physical inventories declining, you have the makings of a perfect storm. This is not financial advice. I'm not telling you what to do with your money, but I am telling you to pay attention. What's happening in silver right now is historic. The open interest explosion is not normal market activity. It's a signal. And if you understand what that signal means, if you recognize the dynamics at play, you have the opportunity to position yourself ahead of what could be one of the most significant moves in precious metals we've seen in decades. The question isn't whether silver is going to move. The question is whether you're going to recognize the opportunity before it's already happened. Because once this thing breaks, once the squeeze starts, there won't be time to get positioned. The move will be too fast, too violent, and by the time you're sure it's happening, you'll be chasing price instead of getting in ahead of it. Watch the open interest. Watch the physical premiums. Watch the inventory levels. They're all telling the same story. And that story is about to have a very dramatic next chapter.